Welcome back to the Rundown Lab, where we break down and fact check the biggest health podcasts. We know your time is valuable, but when you can, we always recommend catching the full episode. Links are in the description. What if the advice you're hearing about paying off your mortgage early could actually cost you money in the long run? Today, we're looking at an episode from The Diary of a CEO that tackled this very topic, and the answer isn't as straightforward as you might think. In this episode, the host explored strategies for paying off your mortgage ahead of schedule, discussing various approaches from making extra payments to refinancing options. It's a topic that resonates with millions of homeowners who dream of being mortgage-free, and there's certainly something emotionally powerful about the idea of owning your home outright. Now, let's talk about what this conversation gets right. The fundamental premise that paying off your mortgage early can save you significant money on interest is absolutely true. If you have a 30-year mortgage and you pay it off in 20 years instead, you will pay less total interest over the life of the loan. That's just basic math, and it's a valid point. The psychological benefit of being debt-free is also real and well documented. Research in behavioral economics shows that debt causes measurable stress, and eliminating that burden can improve mental well-being and provide genuine peace of mind. Additionally, the discussion around making biweekly payments instead of monthly payments is a legitimate strategy. By making 26 half payments per year instead of 12 full payments, you effectively make one extra payment annually, which can shave years off your mortgage. However, here's where things get more complicated. The conversation around whether you should prioritize mortgage payoff over investing oversimplifies a genuinely complex financial decision. The math depends heavily on your mortgage interest rate, your expected investment returns, and your tax situation. If your mortgage rate is, say, 3 or 4%, and historical stock market returns average around 7 to 10% annually over the long term, putting extra money into investments could theoretically leave you wealthier in the end. But this comparison often ignores the difference between guaranteed savings from paying off debt versus uncertain investment returns. Market returns aren't guaranteed year to year, while every dollar you put toward your mortgage is a guaranteed return equal to your interest rate. The discussion also tends to overlook the opportunity cost of having your money locked up in home equity, which isn't liquid. If you need cash for an emergency, you can't easily access the money you've put into extra mortgage payments without refinancing or selling. There are some red flags to watch for in conversations like this. Any advice that presents early mortgage payoff as universally the best choice without considering individual circumstances deserves skepticism. Your decision should factor in whether you have high-interest debt elsewhere, whether you're maximizing retirement account matches from your employer, and what your emergency fund looks like. Putting extra money toward your mortgage while carrying credit card debt at 18% interest, for example, would be financially counterproductive. Similarly, missing out on employer retirement matching is essentially turning down free money. So here's the bottom line. The episode raises a worthy topic, and the desire to be mortgage-free is completely understandable. But the right choice depends on your complete financial picture, your interest rate, your risk tolerance, and your other financial goals. Rather than following any blanket advice, consider consulting with a fee-only financial advisor who can look at your specific situation. The best financial decision isn't always the one that feels most satisfying emotionally. Sometimes it's worth running the numbers before making extra payments.